and that includes gold. So that's not anywhere near the situation we have right now. The first move is a skyrocket. So when the Fed starts, so when the economic data deteriorates later this year, gold is going to take off to the moon, in my opinion. The only thing you have to look at, which will be on my radar, is if we get into a repo crisis, when the money markets get clogged. That would be an occasion for me to sell some of my gold, but it wouldn't be something I would sell for a very long time because I know what's going to happen on the other.
Financial markets are on the edge of big changes, and many experts are talking about a coming crisis that could really shake things up. Michael Pento, an experienced market expert, is pointing out some big challenges ahead. One of the biggest issues is the Federal Reserve's key program ending soon, which has been keeping banks stable. Pento and others think this could lead to a tough time in the markets, especially because banks might have a harder time lending money and have to keep more cash on hand. This crisis is also tied to the Federal Reserve's tough job of keeping prices stable while making sure the financial system stays healthy. With tighter control on the horizon, the Fed's path is getting trickier. In these uncertain times, Pento sees investing in commodities like gold as a smart move to protect against market swings and economic downturns. Pento's advice is making a lot of people think carefully about their investment choices, pushing them towards more solid assets like commodities. This shift shows how investors are getting ready for possible tough times ahead, guided by Pento's insights. It's all about being smart and cautious in an economy that's always changing. Before we dive into Michael Pento's insights, make sure to like, subscribe, and hit the notification bell to help support our channel. Also, check out the pinned comment for some amazing sign-up bonuses. Enjoy the video.
Right now, I only have a very small stake in gold miners. Miners are much better run companies, but they're still stocks. Gold mining stocks aren't gold, and they are stocks. So when the stock market is in trouble, these miners tend to get killed. If you look back in 2008, the miners topped out in the late spring, in the spring of 2008, and then by the time July and August came, the liquidity crisis became particularly salient, and these miners got wiped out because the whole stock market got wiped out. Then they bottomed earlier. They bottomed earlier in the stock market because you want to own miners when the liquidity is pouring into the system. And we just talked about this. In the response to, and I think, yes, I do think we could be headed for another 2008 scenario. It could even be worse than 2008 because, yes, we have massive bubbles out there. We have the bubbles in real estate. We had the bubbles in fixed income. We have an unprecedented bubble in the stock market. So it could be worse than 2008. But in 2008, the Fed, within a year, Bernanke lowered the Fed funds rate from 5.25% to 0. Didn't even blink. Will Powell be able to do that this time? I just don't see it happening that quickly because we know where this road ends. I mean, you could have a stagflationary quagmire in this country like we've never seen before. And that's when you want to own commodities. Let's just suppose Powell is, there's a good case because the Fed exists for what reason? Jesse, they exist to protect the lower and middle classes of the United States citizen? No, they're in existence to protect banks. That's what they're there for. And they'll say, well, if banks don't function well, then that the consumers are finished. And so that's why we have to do what we have to do. But that's not their rationale. That is not their primary target audience. That's not their goal. Their goal is to be the bank for banks. The banker for banks. That's what they're there for. So they could return to ZIRP and QE, and maybe Janet Yellen and Powell will launch helicopter money part 2. But the devastating effects of that for this nation's debt to GDP ratio, for the sovereign bond market, for the dollar, and you want to own commodity. You're gonna want to own commodities in a big way if that's the. I know it disappoints a lot of people, but silver is a base metal. and a precious metal. And unfortunately, it's probably the most manipulated and most frustrating market I've been in this business 33 years, Jesse. I find silver extremely frustrating to even try to invest in. So I have none of it right now. Again, silver might be one of the major holdings in the next reliquification of the banking system cycle that we're going to go through, maybe late in 24 and 25. But right now I hold about 7-8% of the portfolio in physical gold, and I'm very happy to be there. And the catalyst for that is just, we have this country's got such a situation of tenuous asset bubbles that are breaking, though it's being masked by the mainstream financial media. They don't talk about it much, but commercial mortgage-backed securities, commercial real estate properties are in a devastating condition. In fact, if you look at the home price to income ratio, it's higher today than it was even at the peak of 2006 in the previous lead up to the global financial crisis and the collapse of the housing market. It was 5 back then. Now it's 5.5. So we've never been in a worse situation. And home prices are today 50% more expensive to own a home, 50% more expensive than it is to rent. It's never been anywhere close to that. So this situation in this country is very tenuous, and that lends itself to, like, what do I look for when I want to buy gold? I want to see falling nominal and real interest rates. And I think the next move is disinflation and then deflation, and that's when gold just performs spectacularly. So that's the next catalyst that I'm looking for.
Gold has been regaining ground in the past few sessions following its bounce off the 2024 bottom of 134. Although the price has recouped a significant part of its losses, it has currently stalled at the congested region that includes the 50-day simple moving average. Now we'll show you more clips of Bill Holter and Michael Pento, but first, subscribe and turn on notifications, and check our pinned comment for some massive sign-up bonus if you want to add crypto to your commodities portfolio. Enjoy the video.
I look at the second derivative of growth and inflation when I make my determination as to where I want to invest. And I also look at the liquidity impulse and the changes in those dynamics. So come March 11th, the bank term funding program is going to expire. I mean, I can't believe this is actually going to happen, Jesse, but this was the program that bailed out the entire U.S. financial system on March of 2023. Remember, we had these 4 banks go under back then. And the banks had assets that were really a problem. They were mostly treasuries and mortgage-related debt, mortgage-backed securities, CMBS. And they handed them off to the Fed at full value. And even though they were like 60, 70 cents on the dollar, and the Fed gave them Fed credit, 100 cents on the dollar, and told them to go out and make loans and buy more bonds and whatever. And that kind of floated the whole banking system up for the greater portion of like a year and a half. So I'm sorry, a year. And I think that once the bank has to take back their assets at the current value, market value, and then hand the Fed 100 cents on the dollar with interest. Hundreds of billions, there's over $100 billion has to happen. These banks aren't better off now than they were on March 11th of 2023. They're worse. That's a big negative liquidity impulse. Now, in addition, here's another negative impulse that's ongoing. Banks are tightening lending standards. That's already been the case for over a year, about a year and a half to be exact. Now the regulators are raising capital requirements while their assets are eroding even further. So that's 2 negative impulses coming March and April. Around that time, around the end of March, sort of sometime in April, it's just a guess on the trajectory, the vector of the decline in the reverse repo facility, that goes to zero or thereabouts in that time frame. Now, the reverse repo facility is the bank's excess liquidity that they were parking at the Fed out of the whole U.S. financial system, just laying fallow at the Fed, earning interest. And reserves are part of the high-powered money. It's part of the monetary base. It's Fed credit plus physical coins and currency. That's the building blocks of all money supply. It's just laying there fallow at the Fed. That's coming out. It's been coming out from $2.5 trillion to about $500 billion now, coming out and flooding the market with liquidity, bond market, stock market, everything. Well, that runs dry the end of March, early April. And it's at that time, here's the fourth negative liquidity impulse. It's at that time that quantitative tightening will really begin to bite. And we know our lessons of quantitative tightening. This will be the fastest pace of quantitative tightening, 90 billion, 95 billion per month. That's what it's supposed to be. That's really going to put a lot of pressure on the banking system. So that's when I think this whole liquidity impulse that was turned from extremely negative to a positive in March of last year abruptly shuts off. So that's what I'm looking at. It's a very large holding for me, obviously. So I'm not in the T-bills any longer. I moved from the bills to the notes. I want to capture a little of that duration convexity that I will get in a recession and when the economic data deteriorates. And I'm very confident that it will. And in that case, T-bills, you can only make the yield. They don't appreciate in price. So I went for 1 to 3 year treasuries. So I don't want to go out too long on the yield curve because although I think you make some money there, they have a lot of supply and inflation concerns out there. So the long end of the yield curve is mostly concerned about supply and inflation. And there's with $1 trillion in interest that we're paying on our debt, there's a lot of supply concerns out there, Jesse. $2 trillion deficits in peacetime, $2 trillion annual deficits in full employment, in soft landing nirvana. Come on. So the deficits are going to go to $6 trillion per annum in a recession. They'll go from 2 to anywhere between 5 and $6 trillion. That's a lot of supply to absorb. So and then you have inflation concerns. So I'm much shorter duration on the yield curve. What else do I own? I own defensive stocks, low volatility stocks, physical gold. I have a small short in high yield, but I'm not out and out directly short in the portfolio as of yet. I'm waiting for my model. You want some insights into my model. I look at financial conditions. I look at the highly stochastic components to let me know when I should short. Looking at weekly jobless claims, anything the weekly components have to erode. Credit spreads are still quiescent. So those things, the things in my model, there's 20 components, 10 for inflation, deflation, 10 for recession and growth. The model is built to tell me how to front run the little kiddies that run Wall Street. These people, they look at I'll give you a quick example. I call them little kiddies. It's a pejorative term, but they look at the non-farm payroll report and they react to it. They look at the headline. 353,000 net new jobs were created. Oh my God, what a booming economy. And of course, the mainstream financial media just feeds that illusion. But when you look into the numbers, the job market is a disaster. It's deteriorating. You look at I don't want to go into all the numbers right now, but if you look at the household survey, losing jobs, the work week shrank, the employment to population ratio fell, labor force is declining. So it's a bad number, but what I'm trying to say is that I would my model is built to front run what most investors and money managers on Wall Street will do. And they will follow me once I short the market, and I will short the market when the arcane components deteriorate. What the smart money is, and that's in the credit.
What do you think of today's episode? Do you agree with Michael Pento and his current market positioning in gold versus silver? Post in the comment section down below your thoughts on the show, and check this video right here because you'll love it. I see you on the other side.